right.
Hey.
Here we are.
Yeah.
Kevin Chan with Grow. Thanks so much for joining us. Amazing to interview you in this setting.
Yeah. So nice here.
Yeah.
I love it. Yeah.
Okay, so let's talk DeFi meets TradFi.
Yeah.
Okay, so DeFi and TradFi were, until very recently, two completely segregated, separate markets.
hmm
What's happened recently to start this convergence between the two?
Yeah. Well, I like you said the word convergence, which is truly what's currently happening between what used to be two fairly separated markets, right?
Mm-hmm.
So back at the tail end of previous DeFi summer, you didn't have a lot of the current tokenized asset infrastructure, all of the current bridges and institutions that are now on chain today. They weren't really active back then. And kind of the net effect of that was that you had effectively two different capital markets. You had an on-chain capital market and off-chain capital markets. Now, as sort of the value proposition for being on-chain has increased for these institutions, as well as DeFi being more, I think, ready to accept institutional adoption, you're seeing these two separate on-chain, off-chain capital markets begin to converge, as you mentioned, which is definitely a trend that we're trying to take advantage of at Growth.
Mm-hmm. So the first major asset class that has taken off after stablecoins has been treasuries and money market funds. Um, what has been, do you think, the effect of these assets coming on chain in DeFi?
Yeah. Um, so treasuries was the first asset to really be tokenized and brought on chain at scale because it's obviously one of the most liquid assets off chain and in traditional markets. And what that really did is that helped DeFi set a base rate of kind of the treasury rate and the risk-free rate on chain. So now you see basically these on-chain lending markets have that baked into sort of the underlying yield. People accept that the best that they can do, or at least at very minimum, you can get the treasury rate. And that was, I think, a very successful tokenized market that came after stablecoins, which was probably the first successful tokenized product. The other thing that was really important about bringing tokenized treasuries on chain is now investors in these DeFi markets are starting to get more comfortable with how these assets work, right? They're not perfect. A lot of them still have settlement rails that are tied to off-chain processes. But at the same time, they're seeing a ton of adoption across borrow and lend on chain, and they're increasing utility. So I think one of the net effects of these tokenized treasuries is that people started to understand how we can start to bake in tokenized assets into, on-chain markets.
So interesting. Yeah, because before you had the, lending borrowing rates on Aave like completely different from whatever was happening in treasuries.
Yeah.
So yeah, it's good that now we have this kind of base rate. So besides treasuries, you at Grove you're tokenizing other different asset classes. Notably with Janus Henderson, you brought $1 billion of CLOs on chain.
Yep.
Can you talk about kind of the significance of that and what that process was like?
Yeah. So at Grove, we allocated $1 billion into Janus Henderson's AAA CLO product. That was pretty significant in my view because this is really where we start to realize some of the promise of on-chain capital markets start to make an impact in the real world, right? So this $1 billion deployed into AAA CLOs, that liquidity eventually through traditional capital markets, it's finding its way into the hands of US-based companies and US-based consumers. And there's a real impact to that credit being extended through this structured credit portfolio, but initially being allocated from DeFi. And one thing that I'm really excited to see is a lot of these structured credit portfolios and markets start to originate on chain and have that same effect without having to go through the existing kind of capital market structure that we currently have to access these assets through. But nonetheless, the impact is very real, and I'm really excited about that.
So does that mean that, okay, so these structured credit products, the borrowers are getting financing from crypto native investors?
Yep. Yeah. For the very first time. And at a size like $1 billion, that's really starting to catch the attention of traditional asset managers and traditional allocators in off-chain capital markets to be like, wow, there is significant liquidity and they're very sophisticated and they're ready to start to kind of allocate at scale to these credit assets, which drives like not only the US economy, but the global economy.
And then the other deal that you did recently was with Apollo. And yeah, can you talk about that and how that kind of compares with the Janus Henderson one?
So Apollo was also a revolutionary product and revolutionary transaction where we allocated 50 million into Apollo's diversified private credit fund. And once again, you're starting to see on-chain capital markets find its way to the largest asset allocators and managers in Wall Street. Apollo Global, I think, manages over 800 billion today. And once again, like these private credit assets are providing a differentiated yield source to on-chain investors. At the same time, the private credit vehicle off-chain is benefiting from some of the additional utility that's obtained by tokenizing this product. So tokenizing really is just the first step. Like what we hope to do with a lot of these tokenized private credit assets is to start to get them more embedded into DeFi with on-chain borrowing lending, with enabling secondary liquidity, with enabling some of the additional utility that is just much more difficult to achieve had they not been tokenized.
What needs to happen to really integrate these assets more deeply into DeFi?
Yeah, I think really it's pretty simple. I think first thing is really educating the space on how to think about how to underwrite these assets. A big part of what we do is we publish our assessments and we try to make it a big deal when we make an allocation, because generally what we see happen when we make an initial allocation of 50 million, 100 million, 200 million is, other DeFi protocols follow suit. And I think, that's a privileged position to be in, but we also spend a lot of time, due diligencing and finding these assets and working with these partners to make them work in the context of DeFi. So I'm basically, I think I'm losing track from the initial question, but basically I think that one thing that is missing is that as we get more mature about understanding these assets, I think there'll be more adoption.
So do you think it comes down to just broader like awareness that these assets exist, and just like having DeFi protocols like integrate them as collateral? But is there not a piece of like, do holders of these tokens need to go through KYC? Is there like a compliance aspect to it?
Yeah, investor onboarding and satisfying the compliance requirements, I think, is a key step. However, I think the main reason why we haven't had users or investors on board in significant numbers is just because the motivation isn't there yet. And I think, again, part of that is because these markets are still getting started. So from, chicken or the egg perspective, like we're still in this like kind of cold start stage. But once you do see significant liquidity on chain and the experience of getting access to these assets and then using them in DeFi improves, that will motivate people to engage in KYC, engage in compliance, engage in onboarding.
Yeah.
Because the value proposition is much greater now. Yeah.
And then from the asset manager's side, what is their motivation? Like, where are you seeing they're getting the biggest benefit from in doing these tokenized products?
I think two things: distribution and improved offerings. So first, distribution. I think they generally view on-chain capital markets as an untapped new distribution channel that is growing really rapidly and is enabled by a couple key kind of macro trends, that those being the digitization of everything. So crypto and blockchain rails benefits from being very easily adoptable by fintechs and these kind of neobanks and these like financial institutions. So distribution being one. The second thing is, once again, like these asset managers, they're aiming to build the best product, the best experience for their client base, and some of that experience is related to, hey, can I give my client the liquidity profile that they expect? Can I give them the ability to obtain leverage if they so choose? These are things that I think are more difficult to offer to a client base within the traditional finance system. But now it is possible. They can kind of improve upon their current existing offerings by leveraging DeFi. And that's another reason why we see the Apollos and many of these asset managers start to take on-chain capital markets very seriously.
Awesome. Okay, and then to wrap up, what's next? Like, what do you think is the next asset class that makes sense to bring on chain?
Yeah, that's a really good one. I think we're starting to see a lot more engagement from fintech originators. So whether it be PayFi or whether it be payments processors like Stripe, Visa, like I talked to them on, I think they are really starting to view owning the financial infrastructure through blockchain rails, through DeFi primitives like Morpho as a very attractive extension of their existing kind of digital finance ecosystem. And I think the experiences that consumers and users can get through these fintech native distribution channels is just going to be 10x what me engaging in a loan in a non kind of like digital manner will be. So I'm excited to see a lot more types of assets that that don't currently exist today, but are originated by these fintech or kind of digital finance players, and hopefully we can be right there with them, kind of helping that market grow.
Amazing. Yeah, it's definitely just the beginning.
Yeah.
Tokenization is still so small, but I mean, potential is huge.
For sure.
Awesome, Kevin. Thank you so much.
Thank you. Thank you for having me.